Good day everyone! Today I will be sharing on our initiation on Disney and why we prefer Disney over Netflix. In short, we prefer Disney over Netflix because of Disney's brand and content strength. Moreover, Disney is expected to post strong growth ahead. First, let me take you through Disney's business model. From a humble cartoon studio in the 1920s, Disney has become a global entertainment behemoth with a strong brand that many are familiar with. And to remain competitive across the years, Disney has continuously innovated to keep up with consumers' needs, such as the most recent pivot to building its own video streaming platform, Disney+. So Disney has two key business divisions. First, the Media and Entertainment, and second, Parks, Experiences and Products division. The Media division is supplied with content from four groups: Studios, General Entertainment, Sports and International. Looking at the revenue breakdown, the Media division makes up the majority of the contribution with 67% of revenue, and the linear network business is the largest segment of the Media division at 35% of revenue. Essentially, the linear network business distributes Disney's media content through traditional cable and broadcasting channels, while the streaming business is the new model of distributing Disney's media content through its streaming platforms. Disney's streaming business has a few brands including Disney+, ESPN+, and Hulu, which we will take a look at in a later part of the presentation. And so with the ongoing pandemic, consumption has gradually shifted online. As such, the launch of Disney+ in December 2019 proved timely, and this was right before COVID hit. And so over the past 2 years, the streaming segment of Disney grew at a CAGR of 52%, and it was the fastest growth among all the business segments. As seen by the steady growth in the light blue line, the Parks division has also experienced a strong recovery, with for the first quarter 2022 operating margins reaching a record of 33.9%, and this beats the pre-COVID operating margin figure of 33.3% in the first quarter of 2020. And do note that Disney's fiscal year begins in October. These have helped offset the revenue decline in the content sales and licensing business, which largely relies on sales from movie theatres and stage plays, which has stalled due to the COVID-19 lockdowns. And as of first quarter 2022, Disney's revenue has already recovered to pre-COVID-19 levels as seen in the figure. And so, tying all these together, Disney has two key divisions, Media and Entertainment and the Parks and Experiences and Products division. And the streaming business, which falls under the Media division, has performed well and is currently the fastest growing segment of Disney. The Parks division has also staged a strong recovery, reaching back to pre-COVID-19 levels in the first quarter 2022. And this is driven by the strong demand and also price increases. Geographically, Disney gets the majority of its revenue from the US with 80% and a smaller contribution from Europe at 11% and 8.6% from Asia Pacific. Now, moving on to the understanding the media industry. First and foremost, the media industry has seen significant changes over the past decade, with streaming as a new game changer, accounting for as much as 28.7% of viewing time in the US. And this is followed by cable and broadcast, which accounts for 35% and 26% respectively. Streaming platforms have boomed as the lockdowns during COVID led consumers to turn to streaming for entertainment. And we see that this growth is expected to continue at a 21% CAGR from USD 60 billion in 2021 to USD 224 billion in 2028. And so this attractive growth has thus attracted new entrants, which has heated up the competition landscape. But Netflix and Disney remain as the largest two at 26% and over 26% for Disney respectively. So the key difference among the top four platforms is the type and quantity of content provided. In essence, Disney Plus is more niche, offering franchise content such as Star Wars, Marvel, Pixar, Disney and others, and all these are family friendly. While Hulu and Netflix both offer general entertainment content that is aggregated from various studios. Nevertheless, each platform still has its unique content, and as seen in the figure, even though Disney's content is much less than half of Netflix content, but Disney subscribers is only 12% smaller. This shows that Disney is popular even though it does not have an extensive library as the other platforms. The media industry is seeing a decline in the traditional linear TV subscribers, and so we like that Disney has kept its spirit of innovation by venturing into the streaming business. Looking at Disney's figures, Disney Plus subscribers reached 129.8 million as of December 2021, and this is a growth of almost 5 times since its launch in December 2019. Additionally, Hulu and ESPN Plus, owned by Disney, has 45.2 million and 21.3 million subscribers respectively, giving Disney a total of 196 million streaming subscribers. This is just shy of Netflix's 221 million subscribers as of end 2021. Moreover, having the ability to launch productions in various ways enables Disney to be flexible and adaptable. So for example, Turning Red, the movie, was launched in March 2022, and it was originally slated for a release in the movie theaters but was changed to be launched on Disney Plus due to the rising COVID-19 cases. This flexibility was also reinforced by management as a strategy going forward. And so with all that, this leads me to why we like Disney and not Netflix. First, broadly speaking, although we think that the streaming industry can accommodate both players, Disney and Netflix, but given that the two have different content and target audience, we prefer Disney for various reasons. Firstly, Disney is an entire world with a strong brand and a strong content production track record, while Netflix is just a platform that over time realized the importance of in-house content production. Disney's content is one of a kind and cannot be replicated by other content producers. There's no other character that can replace Mickey or Snow White, for example, whereas Netflix content does not have this strong edge. Another example is that while Chinese locally produced content can substitute Netflix, Disney films have no comparable substitute and are screened in China, unlike Netflix. Moreover, Disney films are popular and are remembered by audiences, as seen in how Disney films seem to sustain audience interest in the long term, while Netflix films tend to see significant but brief spikes of interest, as seen in the figure on the slide. And so this highlights that Disney's ecosystem of its strong storytelling capabilities, characters, music production, products, theme parks, and others all form strong touch points with consumers, and hence probably explains why Disney can sustain consumers' interest in the long run. Secondly, given the growth expectations, we think that Disney is more attractive than Netflix, as seen in the table on the slide. The growth for Disney is driven by both its media and parks business, as the company further penetrates in the streaming space and as the parks enjoy a robust recovery from COVID-19. Looking first at the media business, Disney's streaming subscriber growth has beat expectations and has made a strong headway, despite its late entrance in the streaming market. This subscriber growth strength has come about even as Disney's content library lags the other players, as seen on the previous slide. Disney Plus has significant growth potential ahead, given that it is currently in just over 80 countries, while Netflix is in over 190 countries. Going forward, Disney Plus will roughly aim to double its country reach by 2023, as well as increase its content library, which will in turn attract more subscribers. In 2022, Disney aims to double its original content, and over the next 2 years, more than 340 original international titles are in slate. The company also guided that in 2022, Disney intends to spend a total of $33 billion on producing content for its streaming channels, which is 70% higher than Netflix spend of approximately $18 billion. Now turning to the parks division, recovery has been extremely robust as mentioned, with revenue in line and operating margins beating pre-COVID-19 figures. And this is all despite attendance not actually having returned to pre-COVID-19 levels due to capacity constraints in the US and also lockdown in Asia. Margin improvement was actually driven by a more favorable guest and ticket mix, higher food, beverage and merchandise spending, and also contributions from new product launches of Genie Plus and Lightning Lane. And we expect this to continue as the recovery of the parks division continues. So summing up this section, we prefer Disney over Netflix because of its brand and content strength and attractive growth ahead driven by the streaming business's developments and also the stronger than expected recovery of the parks business. So before concluding with valuations, we highlight a few investment risks. First, geopolitical risks. Disney's revenue exposure to Europe is 11%, which could be affected if the Russia-Ukraine crisis escalates, impacting the overall European economy. On another note, Disney also announced that only 2% of its total operating income is affected by Russia and Ukraine. Second, tough competition. So to be a strong contender in the streaming battle, Disney has to continuously produce quality content that fans enjoy. If the competition heightens, spending on content production could rise significantly, which could affect margins. Thirdly, inflationary risk. In an inflationary environment, first, we already see interest rate hikes, and the higher interest rates could result in a lower valuation of Disney stocks. However, we think that with strong earnings performance, Disney should continue to do well. And fourth, if a new COVID-19 variant arises, there could be a new wave and heightened restrictions could delay the recovery of the parks division. So these are just some of the investment risks. And so with that, in summary, Disney is a business that has evolved with time. From the early 90s, when films were black and white, to now when films are accessible on all our mobile devices. Disney's venture into the streaming business has proven more successful than expected, and given the strong brand and content production capabilities, we expect its expansion to continue to bear fruits. Moreover, the parks business has just embarked on the start of its robust recovery, thus further contributing to Disney's overall growth. As Disney's streaming business and traditional business, legacy business are largely different, we apply a sum of the parts valuation methodology on the traditional business and the streaming business. So for the traditional legacy business, which includes the linear networks, which is the traditional way of delivering media content sales, parks and experiences, and also consumer products, these form the traditional legacy business. And so to value this business, we apply a PE multiple of 12.5 times, which is in line with Disney's 3-year historical average from 2017 to 2019, and this is prior to the introduction of the streaming business. For the streaming business, we value the business with a PS multiple of 6.5 times, and this is a 15% discount from Netflix PS 4-year historical average, and this is to factor in the current macroeconomic overhang on equities. Why we have used a PS multiple on Disney's streaming business is because Disney's streaming business is still loss-making and guided to break even in 2024. And this is also to account for the fact that streaming stocks, which are tech stocks, tend to be valued higher than traditional businesses. And so with that, we arrive at a target price of USD 201 based on the 2023 revenue and operating income. And this eventually gives investors an attractive upside potential of over 80% as of 9 May 2022. Moreover, given that the growth stage of Disney's streaming business and the margin expansion of the parks division as written above, an upside re-rating potential still holds. I've come to the end of my sharing. See you again next time. Thank you.